Hello guys, welcome back to our YouTube channel CA Made with Logic. So this is your friend mentor CA Ashish Jain, your audit faculty. Welcome to the world of auditing. So today in this video we will be revising and recapitulating the first chapter of CA Intermediate, which is nothing but nature, objective and scope of audit. There are total 26 concepts which we need to revise in this particular chapter. This is as per regular book. There are total 26 concepts, but I have created a LDR capsule book. There we will be covering only total 17 concepts. I'll be discussing only the total 17 concepts which are important from examination point of view. Like I can give you example that origin of auditing, interdisciplinary nature of auditing. All these things are completely irrelevant from examination point of view. So that's why I'll not be wasting time to discuss all these points in this video, and then you can see that whether audit is mandatory or voluntary, who appoints an auditor, to whom report is submitted by an auditor, meaning of assurance engagement. All these concepts are completely irrelevant from examination point of view. This chapter has a nearly weightage of 4 marks, not more than that. So definitely one short question will be tested from this particular chapter in whatsoever attempt you are writing it. Okay, so let's start discussing each and everything which is important from examination point of view. So let's discuss the objective of audit. As per SA 200, what is the objective of audit? Audit objective is you have to provide reasonable assurance, you have to express an opinion, and then you have to communicate and report. Okay, you have to prepare a report and communicate. Okay, so this reporting and communication we will be discussing more in chapter number 8, whereas expressing opinion also you will be more discussing about audit report and everything in chapter number 8. So reasonable assurance, expressing opinion, and reporting and communicating to the users of the financial statements. So reasonable assurance provide high level of confidence, but it does not complete guarantee. Okay, it does not complete guarantee. So absolute assurance and reasonable assurance are not equal, and auditor gives reasonable assurance, not an absolute assurance. Remember this, very important. Then comes this is a very important thing. So while expressing opinion, auditor have to ensure that accounts are based on entries in the books of accounts. Entries are supported by sufficient appropriate audit evidence. There is no emission in the entries. Auditor have to make sure that management have not omitted any sort of entries. Then information is very clear and unambiguous. Whatever financial amount which the management is doing, all those are properly classified, described, presented as per AS or Ind AS. Okay, that is applicable financial reporting framework. Then statements are present true and fair view of result and financial position. So these are all the total 6 points. I'm going to give you a one simple memory technique how to remember that. You just remember journal entry called machinery account debit to cash. Okay, 50K. So obviously this journal entry you would have passed in the books of accounts. So entry have been made in the books of accounts. Okay, you would have definitely management would have passed in the books of accounts. Obviously on what basis management would have passed in books of accounts the entry? Definitely they would be having some invoices based on which, if they have purchased some plant and property, plant and equipment, they would have got invoice based on which they would have recorded the entry. Okay, so that invoice is nothing but sufficient appropriate audit evidence. Okay, an auditor should not omit this entry, and information should be clear and unambiguous. Okay, then what the financial amount, you can see that 50,000 is the financial amount. This has to be either properly classified, that means machinery has to be properly classified in the balance sheet item under asset side, and cash has to get reduced. Okay, so this has to be properly classified, described and disclosed in as per the Ind AS or AS. Okay, then statement present. Okay, whatever balance sheet and the P&L which the management is preparing, that particular statement represent true and fair view of results and financial position. Okay, I hope this particular entry, if you remember, you can recall all the points very easily. Okay, so the first point is putting entries in the books of accounts. Then comes sufficient, on what basis you are putting entries. There should be some sufficient appropriate audit evidence, and there should be no omission, and information should be clear and unambiguous. Then comes financial amount, whatever financial amount which has been put in the entry, that has to be properly classified, properly disclosed as per Ind AS or AS, that is as per applicable financial reporting framework. Then whatever statements are being presented, that is balance sheet and P&L, whatever statements are being presented, that shows true and fair view, and it has a good financial position. Okay, and financial position, it states the good financial position. Okay, so this is how you have to remember all these 6 points. Okay, then comes scope of audit, what it includes. Very, very important question answer from examination point of view. And this question was tested in September 25 examination, and this question was tested I think in May 25 or Jan 25, I don't remember it properly, but this was also been tested by giving a case study. They have tested this particular concept. So scope of audit, under audit, what all things audit covers? Okay, it covers all aspects of entity and reliability and sufficiency of information. Okay, based on the reliability and sufficiency of information, that means based on accounting records and source documents like bills and vouchers, auditor will, that means management will going to prepare the financial statements. Okay, and auditor will going to do the audit. Okay, then proper disclosure has to be given. Okay, if you see the notes to accounts in the balance sheet, proper disclosure. Okay, when the property, plant and equipment was purchased, how much depreciation have been calculated, what is the closing balance, all these things, proper notes to account should be there for each and every line item. Okay, then comes everything is prepared, judgment by management. Okay, you just take an example of provision for warranty or provision for claiming doubtful debts. Okay, that is provision for doubtful debts. All these things are based on the estimation which are done by the management. Okay, and these estimations should be, these estimations are nothing but accounting policy that has to be properly appropriate and consistently applied. Okay, you just take an example of depreciation method, that is an accounting policy. Depreciation method, choosing a depreciation method is an accounting policy that has to be appropriate and consistently applied. Okay, whether the management have consistently applied the SLM basis straight line method of depreciation, or whether they have continuously or consistently applied the WDV method. Okay, auditor have to check it. Okay, so it is based on judgment by management. Then history of financial statements. Okay, if you see the preparation of balance sheet and P&L, all these things are being prepared based on the past events and the economic condition. Okay, so past event and the economic condition is the keyword which you have to write it. Okay, so these are all the scope of audit which is included. One is coverage of all aspects of entity, reliability and sufficiency of financial information, that is based on accounts, documents, accounting records. You will going to prepare the, you mean management will going to prepare the financial statements. Then proper disclosure has to be given. Okay, then judgment by management and historical financial information. I have given a related icons. Okay, I have given a related icons related to this blue color word, so that you can hide these blue color word using your right hand, and you can just see this particular icon and try to recall the points. Okay, this is a best method to recall the things. Then comes scope of audit. So we will be now discussing the concept number 3, which is scope of audit. What it does not include in the scope of audit, what all things are not included in the audit. Okay, if you see the technical evaluation, the first point is technical evaluation. Auditor is not responsible for assessing the physical condition or life of technical asset. Okay, auditor will not going to say that this particular asset will going to last for 10 years. Okay, he is not going to give the estimation of that particular asset. Okay, he is not meant for that. So technical evaluation is not auditor's job. Then he is not expert in authentication of document. Okay, whether that particular document is genuine or not. Okay, whatever document provided by the management are genuine, that particular document is genuine or not. Auditor's duty is not to verify that whether that particular document is genuine or not. Okay, so he is not expected. Okay, remember this word, not expected to verify genuineness of document. Then comes investigation. Audit is actually not an investigation. Investigation usually done in case of fraud. Okay, okay, audit is not an investigation into fraud or wrongdoing. Okay, so in investigation only fraudulent activities are being detected, yeah, are being done, and then comes their in-depth checking and analysis is being done in investigation, whereas in audit you will be doing things on sampling basis, and you will be giving opinion based on the sample drawn on the population or something. Okay, so the auditor lacks legal power. Okay, so this is investigation point. Then audit versus investigation. Audit in is general and broad, whereas investigation is specific and narrow. Okay, it has some particular purpose like fraud detection or something. Okay, so this is what these 4 points you have to remember in scope, which is not been included in audit. Okay, very simple. Then comes to concept number 4. Okay, inherent limitation of audit, very important concept this is also. So auditor cannot provide absolute assurance due to following limitations. Okay, due to following fundamental limitations. So one is I'll be first discussing all the main headings, then I'll be discussing each and every point what has to be written. Okay, so one is nature of financial reporting, then comes nature of audit procedure, not in the nature of investigation, timeliness of financial reporting, future event. Okay, so these are all the key points. These are all the 5 points which you have to write in your examination if there is a question related to inherent limitation of audit. So now I'll be discussing what is nature of financial reporting. Okay, you know well that financial statements, more than 30 to 40% in financial statements, things are being done based on judgments and estimates. Okay, so judgments like if you want to create provision for warranty, provision for doubtful debts, okay, all these provisions are being done based on some estimates or based on judgment by the management. So nature of financial reporting. Okay, since these things are being done based on judgments or things are being done based on estimates, you cannot exactly predict. Okay, that you cannot exactly say that these financial statements are complete pure. Okay, auditor cannot say that these financial statements don't have any sorts of free from material misstatement. You auditor cannot say it because few things are being based on judgments. Okay, even auditor don't know whether the estimates are being done properly or not. Okay, whether it is excess, whether it is understated. Okay, all those provisions which are being created. So nature of financial reporting. Then comes nature of audit procedure. You know well that auditor cannot check all the 100% items. Okay, he cannot verify all the 100% items. He can only do sampling things. Based on sample, he will going to draw the conclusion. Okay, that's what this particular point talks about. Okay, so audit is not in the nature of investigation. Okay, auditor lacks that legal power. Auditor don't have that legal power to enforce complete disclosure or conduct forensic style inquiries. Okay, he cannot do forensic style inquiries and all. Okay, he just have to check out few transactions and draw conclusions. And then comes timeliness of financial reporting. Okay, there is always auditor must strike a balance between reliability and cost effectiveness of information obtained. Okay, auditor has to always think about the cost and the benefit. Okay, how much cost he is incurring to get the benefit, how much benefit he is getting from that. Okay, so timeliness of audit. Then future events. Obviously unpredicted future events can happen, like COVID situation. You can imagine, you cannot predict how the business will going to perform during COVID times. Okay, so this is future. Auditor cannot predict those future events, how the business will going to react and will going to impact. Okay, how the business will going to impact due to COVID-19 or something. So future events cannot be predicted. Auditor cannot foresee or prevent adverse future outcomes. You can remember COVID-19 example. Okay, then comes what are all benefits of audit, why audit is needed. Okay, so you just imagine why audit is needed. Okay, why a company will going to gets his books of accounts audited from a third person. Okay, why it is actually needed? Because shareholders confidence is very important. The government need taxes, if a company wants to raise a loan from a bank, then obviously the credibility of that particular bank has to, that means the credibility of the company should be there. Okay, then only the lender of that particular bank can give the loan. Okay, so obviously the lender reliability should be there. Then for detecting the frauds and error, review of controls, okay, whether controls are being properly operating effectively or not. Okay, for reviewing the controls, government reliance, lender reliance, and then moral check, okay, shareholders confidence, to give the confidence to the shareholders, to the investors who have invested their hard earned money in the business. Okay, then audit accounts provide high quality information. Okay, so audit, if your books of accounts are being audited, definitely that particular company has a global recognition. Okay, it can go abroad and raise funds. Okay, that's why high quality information, that is globally recognized accounting standard, and user confidence will going to get boost. Okay, will going to get enhanced. Okay, so these are all the benefits of audit. One is shareholder, very common points which you have to write it. One is related to shareholder, another one is related to governance, third one is related to lender, detection of frauds and errors, and review of control. Okay, so if you even remember 5 points, it's completely good. Okay, then comes meaning of assurance. Okay, assurance is nothing but an assurance where an auditor express a conclusion. Okay, he express a conclusion to improve the user's confidence in evaluating the subject matter. So what is meant by subject matter? Sir, what is meant by subject matter in this situation? Subject matter is nothing but financial statements. You just read it now again. Auditor express a conclusion. Okay, to improve the user's confidence. Okay, he will going to express a conclusion so that users will going to get the confidence based on what? Okay, based on evaluation in the financial statement. The subject matter, the example of subject matter is financial statement using some suitable criteria. Okay, the suitable criteria can be law or accounting standard or Ind AS something. Okay, how an auditor will going to give a conclusion? Okay, he will going to give, auditor will going to give a conclusion based on evaluating the subject matter, which is financial statements, and a suitable criteria, using a suitable criteria which is Ind AS, by following the Ind AS and the law. Okay, that's how we will going to give a conclusion. Okay, so this is the meaning of assurance engagement. Okay, then comes element of assurance engagement. This is also very important, good question. So elements of assurance engagement, there are total 3 parties are involved. One is the practitioner, whom we call it as an auditor as well. Then the responsible party, which is the management, and the intended user. These are the 3 peoples who comes into the role. Okay, then comes appropriate subject matter. You can see the example of appropriate subject matter is the financial statement, and the suitable criteria is nothing but benchmarks such as accounting standard, law, or guidelines. Okay, so these are the suitable criteria based on which auditor will going to follow whatever the accounting standard says, whatever the Ind AS says. He'll going to just follow it, and he'll going to verify whether the financial statements give a proper conclusion. He'll going to give a proper conclusion. Okay, proper opinion or conclusion. Then comes sufficiency is nothing but quantity of audit evidence. Appropriate is nothing but quality of audit evidence. And written assurance report. Obviously, it's a written assurance report. Okay, auditor finally will going to give an audit report which will going to speaks everything. Okay, how the company have whether the company have done any fraud or not. All those things will be covered in the audit report. What opinion auditor has given, whether they have given qualified opinion, adverse opinion, disclaimer of opinion, all those things will be covered in the audit report, which we will be learning in depth in chapter number 8. Okay, then comes meaning of review audit. Okay, so this is concept number 8. Okay, you just imagine it is nothing but you will be giving an reasonable assurance. Okay, what type of assurance you will be giving? Reasonable assurance. Whereas in case of review is nothing but you just imagine the quarterly financial statements of listed company. They have to publish the quarterly financial statements every 3 months. Okay, so instead of doing audit, what an auditor will going to do, he will just going to do the review and will going to give a report, review report. He will going to issue a review report. to that particular 3 months period quarterly financial statements of any listed company. Okay, he'll not going to give an audit report. Okay, he will going to, instead of giving audit report, he'll going to give a review report for that particular 3 months, because auditor usually done for 12 months. Okay, whereas review is usually done for 3 months. Okay, remember this. So type of assurance is reasonable assurance engagement, whereas in review you will be giving limited assurance engagement. Level of assurance, it is very high level of assurance you are giving in audit, whereas it is moderate or lower than audit. Okay, it is moderate and lower than audit. Nature of opinion, you can see positive opinion are being given, whereas negative assurance in review, negative assurance will be given. I'll be giving you how a negative review report has been prepared. I'll be giving you that particular line what has to be placed while giving a review report. Okay, I'll just wait for 2 to 3 minutes. Extent of procedure, you can see extensive audit procedures are has to be performed in audit, like testing, test of control, test of detail, substantive analytical procedure, everything has to be done in audit, whereas in case of review only limited procedures like inquiry or analytics has to be done. Okay, so these are all the 4 points, 4 differences which you have to remember. Then evidence obtained, sufficient appropriate evidence will be obtained. Here less amount of evidence will be obtained, since you are doing audit of 3 months period quarterly statement, you are doing review of 3 months particular financial statements. You will be getting only less amount of evidence. Okay, then comes outcome. Okay, auditor will going to give opinion. Here the wording the practitioner will going to use is, practitioner states nothing has come to our attention. Okay, so you can see that nothing has come to our attention. We ourselves don't know, in our opinion nothing has come to our attention whether the financial statements of this particular company doesn't show any true and fair view or something. Okay, he's going to give a negative opinion. Okay, you can see that negative assurance is being given. These wordings are looking like negative wordings. You can feel that nothing has come to our attention, we don't know. Okay, in our attention nothing has come to our attention. Okay, then cost and time, it is more costly and time consuming. Audit is more costly and time consuming, since you will be doing audit of 12 months, whereas in review since you are doing 3 months review report, there will be less amount of cost will be involved. Okay, so less costly and quicker. Applicability is, it is required for statutory audit. For statutory audit 12 months audit has been done, whereas often used for interim report, all voluntary review is also being done. For example, if the particular company is not a listed company, they don't need to publish the quarterly report. Okay, quarterly financial statement, they don't need to publish it. Okay, when they don't need to publish it, but the management feels so that they want to give interim report, they want to give an interim report to the users of financial statements. At that point of time, either the management feels to get the those 3 months particular financial statements can be done as a review or not. Okay, so based on historical financial statements, both are based on historical financial information. So this is the common point which you will going to see in both the things. Okay, then comes a type of assurance engagement. Okay, one is reasonable assurance and limited assurance. Now only we saw that review gives a limited assurance report, whereas audit gives you a reasonable assurance report. Okay, you can see this is an example audit engagement, this is an example of review engagement. Limited assurance engagement is an example of review engagement. Okay, then comes reasonable assurance engagement, provide higher level of assurance. Here comes limited assurance engagement, provide lower level of assurance than the reasonable assurance. Then here comes, you will going to perform elaborate and extensive procedure in case of reasonable assurance, which is nothing but audit. In case of audit, you will be performing elaborate and extensive procedure, whereas in case of limited assurance, you will be performing only less amount of procedures. Okay, you will be drawing reasonable conclusion, here you will be drawing limited conclusion. Okay, then comes example which we have already discussed it. Okay, then comes to concept number 9 itself. There are few points. Prospective financial information. Prospective financial information. The word prospective itself means something you are going to predict for the future. Okay. So auditor see prospective financial statements. First of all, try to understand one thing. What is the purpose of creating prospective financial information? For example, if a company wants to get a loan from a bank, okay, obviously the bank wants to know that whether how the company will going to perform, what will be its sales in the next 5 years, okay, what will be its forecasted sales in the next 5 years, then only based on which the bank will going to sanction the loan. Okay, so that's why prospective financial information has been prepared. Okay, so these prospective financial information, obviously management would have taken some sort of assumptions, because it is the future event cannot be predicted, based on some assumptions and forecasting the projections. Okay, you are forecasting the projection based on some assumptions. Management would have prepared the prospective financial information. So financial information is based on assumptions about future event, okay, and possible action of entity. It can be a forecasting, projection, or combination of both. Okay, it can be forecasting or projecting. Okay, both the things can be done. Then comes, if you see the practitioner here, whenever the prospective financial information is being, the word prospective financial information is, whenever you see this particular word prospective financial information, always use the word practitioner. The practitioner must obtain sufficient appropriate evidence. Okay, here auditor will not going to collect audit evidence. Okay, since it is not an audit, prospective financial information is not an audit, so don't use the word audit over here. Sufficient appropriate evidence to confirm. Now we will be writing these 4 points. One is, information is properly prepared on the basis of assumption information is properly presented, all assumptions are adequately disclosed, and management assumptions are not unreasonable. Okay, so these 4 points. One is, whatever, okay, whatever financial information is being prepared, it is being prepared based on the basis of assumption. Okay, and then information is properly presented. Okay, the information has to be properly presented. Obviously the financial information, it has to be presented in balance sheet or P&L, or you will be creating balance sheet for next 5 years. Okay, that is how it has to be presented, and all the assumptions has to be adequately disclosed. Okay, whatever assumption management have taken, they have to adequately disclose it. Okay, and whatever management assumption have taken it, that are not reasonable, that are not unreasonable, that are not unreasonable. Focus on the word not unreasonable. Okay, all those assumptions are not what can I say, unrealistic. Okay, unrealistic also you can use over here, or not unreasonable. Okay, so these 4 points which you have to remember. So how can you remember? I'm going to give you a super memory technique for this. Just imagine a master chef. Okay, everyone would have seen the session, that is serial called Master Chef in television. So the master chef is preparing a dish. Okay, so first is nothing but preparing. Okay, based on some assumptions, he's preparing this based on the assumption. Just replace this word of assumption with a recipe. Okay, he's preparing food based on some assumptions, that is called recipe, and he's going to present it. Whenever I don't know how many have seen the master chef, they will going to, after preparing, they will going to present it to the judge. Okay, so the information is properly presented, and then all the details, all the assumptions are properly disclosed. Now the judges of master chef will going to ask what all things you have added, what all elements you have used in your recipe. All the things has to be disclosed by the participant. Okay, Then whatever management assumption, those are not unreasonable. Okay, whatever management have used in preparing that particular recipe, all those things are not unreasonable. Unreasonable means all those things are not unrealistic. Okay, they have not used the color coated artificial color food products and all. Okay, everything they have disclosed it. So first the master chef is preparing, okay, then they are going to present it to the judge, then all the information, all the assumption has to be disclosed it to the judges of the master chef. Then whatever assumption, management assumption are not unreasonable. Okay, so these are all the 4 points which you have to remember. And remember one thing, practitioner cannot, okay, practitioner cannot assurance the actual achievement of the projected results. Okay, now the management have prepared the the futures next 5 years sales he has predicted, management have predicted and prepared a balance sheet for the next 5 years. Here the practitioner cannot assure whether the particular management will going to achieve it or not, actually going to achieve it or not, he will not going to assure. Okay, remember this. Okay, therefore the report issued provide a moderate or limited assurance. Okay, limited assurance only auditor will going to give, stating that nothing has come to the practitioner attention to indicate that the assumptions are unreasonable. Whatever assumptions management have used to prepare the prospective financial information, all those assumptions in my attention, they are not unreasonable. I am going to say that. Okay, who is going to say? The practitioner. So this wording you have to definitely write in your examination. Nothing has come to the practitioner attention to indicate that assumptions are unreasonable. Okay, assumptions are unreasonable. Then comes engagement and quality control standard and overview, concept number 10. We know that standards on auditing is related to audit of historical financial information. Okay, audit of historical financial information deals with the standards on auditing. Then standards on review engagement, these are nothing but review of historical financial data or information. Okay, so I have already given you interim report has been prepared or quarterly report has been prepared. Okay, all those things are example of review engagement. Then comes standard on assurance engagement. Okay, these are nothing but assurance engagement other than audit and review. Okay, other than audit and review. Okay, you auditor or the practitioner is giving assurance other than audit and review. Remember this. Okay, then comes standards on related service. These are nothing but agreed upon procedures or compilation and related service. Here on standards on related service, auditor or practitioner is not going to give assurance. Remember this. Assurance is not been given in related service. Very, very important. So please don't use the word audit over here. Okay. So sufficient appropriate evidence only you have to use. Okay. Don't use sufficient appropriate audit evidence. Sufficient appropriate evidence only you have to write in your examination. Don't use the word audit over here. So all these 4 things you will be learning in depth in your CA final, nothing to worry. So one is standards on standards on auditing, which talks about audit of historical financial information. Then standards on review engagement, which talks about review of historical financial data. Then standards on assurance engagement, which is nothing but you will be auditor or practitioner will going to give assurance other than audit and review. Okay, other than audit and review, very important. Then standards on related service is nothing but your management agreed upon procedures are nothing but management himself will going to give some sort of procedures that has to be applied. Okay, auditor or practitioner, what he will going to do, he'll just going to follow the instructions of management and he will going to apply that particular procedure. That's it. Okay, his job is done. So in agreed upon procedure, I can give you an example. Management himself will going to give how you have to do, how you have to check or verify the transactions or the account balances of trade payables. Okay, transactions and account balances of trade payables, how auditor have to, that is practitioner have to verify, management himself will going to say it. Okay, so agreed upon procedures is nothing but management himself is going to give agreed upon procedures to the practitioner. Only what is the duty of practitioner? Practitioner will only going to verify whether whatever agreed upon procedures given by the management are properly done or not. That's it. Okay, he'll just going to verify it. Okay, he's not going to give any sort of assurance, and sufficient appropriate evidence has to be obtained. Okay, to get to know whether agreed upon procedures have been appropriately applied or not. Okay, so now we will be discussing each and everything in a detail. Okay, standards on assurance. Okay, standards on auditing. So audit, this is nothing but the audit of historical financial statements by independent auditor. It is a high quality benchmark, and here you will be giving reasonable assurance and extensive procedures and evidence you will going to obtain. Who auditor will going to obtain. Okay, then comes standards on review engagement. We already know that on standards on review engagement, limited assurance engagement has been given. We have already seen in this box itself, limited assurance engagement has been given. Whereas if you see over here, reasonable assurance engagement and reasonable assurance engagement has been given. Okay, in case of standards on auditing, or in case of standards on review engagement, limited assurance engagement is been given. That is lower assurance than audit. Fewer procedures are being applied. We have already seen here that only limited procedures, that is inquiry and analytics, only been applied. So fewer procedures or limited procedure, both the wordings you can use in your examination. And sufficient appropriate evidence. Don't use the word audit over here. Remember this. This is a review, not an audit. Okay, you will be giving review report of that particular 3 months only. 3 months quarterly financial statements you will be giving review report, not an audit report. Remember this. Okay, so there are examples of SRE, that is SRE 2400, SRE 2410. So all these things you will be learning in depth in your CA final. Okay, you can just remember the name of this particular thing, and example can also be tested for 2 marks. Okay, so just try to remember these two names. Okay, so remember one thing, both in SA and SRE applies to engagement involving historical financial information. We have already seen it over here. Both the things, whether it is audit or review, both the things are being based on historical financial information. Okay, I hope you got it. Then comes standards on assurance engagement. Standards on assurance engagement is nothing but you will going to give assurance other than audit and review. Okay, so it is an assurance engagement that do not involve audit or review of historical financial information. So you will not going to other than audit and review of historical financial information. Auditor or practitioner will going to give assurance engagement other than audit and review of historical financial information. Remember this. So again, there are total 2 examples. For example, you can see that SAE 3400 and SAE 3420, these 2 standards, you can see that examination of prospective financial information. Okay, and here moderate and reasonable assurance is being given, and it does not involve audit or review of past financial data. Okay, so these things you can write. Okay, this is other than historical data, other than historical financial statements. All these words you have to definitely use it. All these blue letter words you have to definitely write in your examination and come, then only you will be getting marks from ICAI. Then standards on related service. You can see standards on related service. There is no assurance word being used in this particular heading itself. So you can see that practitioner does not express an opinion or assurance. Okay, practitioner is not going to express any opinion or assurance. You can see in the heading itself there is no word of assurance being used. Okay, so here you will be performing agreed upon procedure. Compilation engagement. Compilation engagement is nothing but practitioner. Okay, use the word practitioner, not auditor also. Okay, use the word practitioner will going to assist in preparing the financial statement without providing assurance. Okay, he will going to assist. Okay, who? Practitioner, not the auditor. Okay, usually both the things are same person only, but on standard, okay, while drafting the standard they have used the word practitioner, so it will be better for you to use this particular word so that even the ICAI don't reduce the marks. So practitioner will going to assist in preparing the financial statements, or you will be going to perform any agreed upon procedures which are given by the management. Okay, so here there is no assurance or opinion is being given. Okay, you can see in the heading itself there is no word of assurance is being given. Okay, that's how you can remember it. Okay, so SRS 4400, which talks about engagement to perform agreed upon procedures, and SRS 4000, that is 4410, which talks about compilation engagement. Okay, these services are procedural or assistive in nature and are not meant to provide assurance. Okay, which we have already seen, not that much important. Then comes standards on quality control. We will be discussing more in depth about this SQC1 and SA220 in chapter number 11. I'll be just discussing SQC1 applies to all the services, whether it is audit, whether it is review, whether it is assurance, or whether it is related services. SQC1 applies to all the four things. One is, you can remember like this. One is audit, another one is review, another one is assurance, another one is related services. On all the four, SQC1 applies. Okay, remember this. Very important from MCQ point of view. What is the primary objective of this SQC1? Okay, so the primary objective of SQC1 is firm and the personnel. Okay, the firm and inside the firm, whoever employees are there, they have to comply with the professional standard and legal and regulatory requirement. Okay, the firm and its personnel and their personnel, whosoever associated with that particular firm, employees, everyone. Okay, they have to comply with the professional standard and the legal and the regulatory requirement. Sir, what is professional standard been representing over here? Professional standard is nothing but all the Ind AS, AS, standards on auditing, all those things needs to be is covered in the professional standard and the legal and the regulatory requirement. Legal and regulatory requirements is nothing but compliance of appointment of an auditor. Okay, all those things. Okay, section number 141, 138, 139, all those things are being covered in legal and regulatory requirement. SQC1 says that the firm and the personnel have to comply with the professional standard and legal and regulatory requirements. Then comes SQC1 have to also says what is the second primary objective is they will going to issue report. Report has been issued are appropriate and reliable. Okay, whatever report is being issued, okay, audit report is being issued, that are appropriate and reliable. Okay, this is what SQC1 talks about. Then why are standards needed? Okay, I hope you got it. What there are total two primary objective of SQC1. One is the firm and their personnel have to comply with the professional and legal and regulatory requirement, professional standard and legal and regulatory requirement. Another one is report has to be issued appropriately and that report has to be reliable. Okay, what report? Audit report. Okay, so here the report represent audit report. Okay, why are standards needed? You just imagine why are we learning these standards? Obviously these are the global benchmark. Okay, then users will going to get the confidence. Okay, you can improve the quality and reliability of the financial reporting. Then uniformity and consistency, ensure credibility and users trust. Okay, you can confidence of the users will going to get boosted if you are following these standards on auditing. Then equip professional with knowledge and skill. Okay, so these are all the 5 points which you have to remember. One is it is a global benchmark. Why standards are needed? Because it ensures audit are done as per the global benchmark. It improves the quality and reliability of financial reports. Then comes it promotes uniformity and consistency. It equips a professional with knowledge and the skill, and it ensures that audit credibility and users trust. Okay, users confidence it boosts. Then duty in relation to engagement and quality control standard. Okay, so professional accountants are duty bound to adherence to the applicable standards in all engagement. Okay, remember this word, in all engagement. Okay, professional accountants. Who are professional accountants? Auditors are nothing but professional accountants. are duty bound. They are duty bound to adherence to applicable standards. Okay, they are duty bound to follow the standards in all engagement. Okay, in all engagement means audit, review, related services, and assurance, everything. Okay, in all the situation, the practitioner, that is the professional accountant, are duty bound to follow. Okay, to adherence means to follow the applicable standards. Applicable standards means standards on auditing. That is, for audit you will be, it is standards on auditing. For review it is standards on review engagement. For related service, standards on related service, which we have already seen, standards on related service. For assurance, standards on assurance engagement. Okay, which we have already seen. That's why they have used applicable standard. Okay, they have used the word called applicable standard. They have not used the word standards on auditing, or they have not used the word standards on a related service. They have not used like that. They have used adherence to applicable standards. Okay, these are all the applicable standards for the respective things. Okay, then in exceptional circumstance, in some rare situation where a professional accountant is not able to adherence to the applicable standard, okay, in that situation what has to be done is the thing which we will be writing it. Okay, so then document the alternative procedures used and how it meet the same objective. Then record the reason for deviation and then highlight the deviation in the report. So if the professional accountant is not able to follow the applicable standards, whatever applicable standards, then in that situation, auditor, that is the professional accountant, have to document what is the alternative procedure which have been used, how you have meet the objective of that particular standard, and you have to record the reason for deviation. Why you were not able to apply that particular standard in that particular situation, you have to record it. Okay, you have to record it. Then you have to highlight. Okay, after recording you have to highlight the deviation in the report, so that users will come to know that they have not complied with this particular standard because of these reasons. They have to, how they will going to come to know, you just imagine how the users will going to come to know, because of report only. Okay, so that's why in report they have to highlight the things and they have to record the reason, for what reason there was a deviation. Okay, for deviation, okay, they couldn't able to apply that particular standard. What was the reason for not able to applying that particular standards on auditing, or standards on review engagement, or standards on assurance service, or standards on related service? All those reasons has to be recorded, and you have to document the alternative procedures which has been used and how the same objective have been met on. Okay, how it meets the same objective. Okay, how it meets the same objective, all those things has to be documented. What is the alternative procedure they have applied it, that alternative procedure, obviously they or practitioner have to document and keep it, and they have to give it the information to the users. How they can give it? By highlighting it, in highlighting the deviation in the report, and they have to also record the reason for the deviation. Okay, record the reason for the deviation. Okay, these are all the 3 points, and this is a very important concept, and one question answer is also is there in our study material related to this concept. So if you revise these 17 concepts, you are done with this chapter number 1. Very easy and simple chapter. I hope you have enjoyed it. I hope you have enjoyed our memory techniques wherever I have used it. So you can keep watching this video for multiple revision times, and if you like it, please do like and share with your friends, and thank you so much for watching it. Jai Hind, bye bye, take care.